Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and here are some of the trends we're going to be diving into. It was a mixed trading day on Wall Street, investors weighing Walmart's earnings and other retail sales data. A good session for most major indices. The S&P 500 rose for a fourth day. The Dow closed up too, but the Nasdaq did see a slight dip, closing lower. Well, fintech star Robinhood has been busy with investors using its platform. We're going to be speaking with Robinhood's chief brokerage officer on how retail traders are playing all this volatility. And we're taking a look at the business of sports as well. Will consumers want to play ball with ESPN's pricey new streaming service? And a stake in the San Francisco 49ers is up for sale. We're taking a look at those sports stories and more. Well, retail traders have searched for opportunities amid wild market swings, but where have they been flocking to? Here with a closer look, we have Robinhood Chief Brokerage Officer Steve Quirk. Steve, it is great to see you as always on the show. You always have interesting line of sight, of course, Steve, into retail traders. So maybe just start there broadly, Steve. The customers on Robinhood, what interests them right now? What excites them, Steve? What have they been buying?
Oh, thanks for having me and good to see you. It's definitely been an interesting market in the last month, but we just released our metrics, our monthly metrics, so it gives us a good view of what customers have been doing. And what we saw was one of the best months we've ever had in deposits. So clearly our customers saw opportunities, to buy the dips. And our equity volumes were something we haven't seen in 4 years. And our option volumes were also close to all-time highs. And our margin balances have pretty much been holding steady. So, it was an opportune time for our customers to step in. And some of the names, the most popular names that they like to trade, the Amazons, the Apples, NVIDIAs, that, there was a perception we're going to be really harmed by what was being proposed from a tariff standpoint. They saw, some depreciations of 50%, and, now they're back to previous levels. So, from a customer standpoint, I would say customers really kind of stepped in, and I would say, we've been reading a lot about retail in general, which has sort of stepped in and been opportunistic. So it's good to see.
So you mentioned it. So Amazon, Apple, NVIDIA. So we have a big tech theme going on, Steve. What do you make of that? Did that surprise you in any way?
No, I don't think it surprised me because they're some of the most popular names, from a retail trading standpoint. I think the other thing that we saw, and this tends to happen broadly with retail traders, is when you get extreme moves, and we had some pretty extreme moves. I mean, we're talking about a VIX over 60 and a depreciation in the overall market of 20+% in a very short period of time. You do see customers move away from some individual names and move into broad-based ETFs. And the thesis is they have less conviction about one single name rebounding and more conviction about the market in general rebounding. So as soon as we get a less volatile marketplace and a rally back, you tend to see customers gravitate back into the individual names, and we've seen that.
Who is the typical kind of Robinhood customer right now, Steve? Who is the retail trader, in terms of age, demo, and has that evolved at all?
Oh, yes, it's evolved. So Robinhood's customers are younger, 26 million, almost 26 million, and half of them are first-time. So first-time brokerage customers. They've grown up with us, and right now average age is mid-30s. So some of them have lived through these volatile environments before, whether it's COVID or whichever other shock we've seen to the system. And as a result, I think they understand they have a long investing career ahead of themselves, some 20, 30 years. So, when they see names go from levels which they liked to a level that's 25 or whatever, 30, 40% below that, they step in and, they've been rewarded as a result of it.
And Steve, you all, of course, push beyond just stock trading. You launched the prediction markets hub as well. I'm curious, what are the trends there to call out?
I would say the trends there are like the prediction markets and the event contracts are in our mind, going to be a really interesting derivative of other marketplace. So like, a lot of the economic numbers that we have contracts on are the things that drive the market to either move higher, lower, whether that's CPI, employment, whether it's, whether the Fed's going to have an action or the price of energy. I think these things are what move the market, and what a lot of customers have interest in is instead of having to buy a basket of equities in order to capitalize on a positive or negative economic number, if they can do it directly off of the number, I think they find that to be kind of fruitful. I think the other thing it does is it gives them an avenue to be able to see what the perception of these moves is going to be.
Steve, always great to see you and to have you on the show. Thanks so much for joining us today.
Thanks for having me.
Stick around. Much more Ask for a Trend that's still to come. Well, the Nasdaq snapping its 6-day win streak while the S&P 500 extends its gains. And here with the trading day takeaways is Yahoo Finance's Josh Schaefer.
Josh, so we had a lot of economic data this morning, and I want to start there because it was sort of interesting. So we had retail sales for the month of April. They very, very tinily increased right after this big jump that we saw in March. So there is some signs of the impact of tariffs here, right? Because you had tariff front running,
right,
and then retail sales are month over month. So if you bought a lot of stuff in March, it doesn't really make a lot of logical sense that you would then buy the same products in April, right? So you see the fall off there. But what's been interesting talking to economists is they look at data like this and they don't really know what to make of it. And I think that was similar with the inflation reports we got this week. We had PPI this morning, producer prices. We had CPI, consumer prices. Both were softer than expected. But economists essentially taking that and saying, I don't really know what to do with this right now, and we're kind of just still in this wait and see mode where this type of data doesn't feel like it's really moving the market to the extent that maybe it normally would be.
Yeah, that's what it felt like. Investors had, it was a huge rush of economic data, and people looked through it, and it was interesting, but then I think a lot of investors felt like it was backwards looking, and it's just too soon to gauge the impact of tariffs, which we still feel like are in front of us.
Right, and so you had this news this week, right, of course, with the U.S.-China tariff pause, pretty early in May, I should note, based on a lot of economic data that comes out sort of in the first 2 weeks. So I think maybe when you get to June, and you start to get to this tariff rate that we're at now and get data from that, maybe we can start to get a little bit more
because you read a lot of research. I mean, is that where, and everyone has their different timelines and bogeys, but that's the big question. When does this soft data translate to the hard data? Is that what a lot of folks are
Early summer is the running phrase on the street right now, Josh. So essentially probably end of June, some of that data that comes at the end of the month, and then by the time we maybe get to the June jobs report in that first week of July, at that point people think, okay, if tariffs are impacting this economy, significantly impacting economic growth, we should have a solid sense by that point. But again, that's still 2 months away essentially at this point.
Yep.
And the other interesting thing that happened in the market today, you hit on it off the top, Nasdaq snapping a 6-day winning streak, but the S&P 500 closed higher, right? And so we look at this board a lot, Josh, and you see these three sectors leading, right? Well, today actually had utilities, staples, a little bit of a defensive slant, even healthcare, and then you flip over inside that Nasdaq 100. It just wasn't a day for the Mag 7, which I thought was interesting because really over the last week, over this rally, we'll flip it to a 6-day, it's been all about the Mag 7. So you're starting to see some buying action spread to some other areas of the market.
Did you see that as a sign of, okay, could that signal the moves in tech? I mean, could that signal some caution creeping in the background?
Perhaps, maybe a little bit, but I also think, so we're on the 6-day screen here, and a lot of what you hear strategists start to talk about as you get several days into these rallies is, well, people are going to start buying laggards. So look at your 6-day screen, consumer staples and healthcare had been lagging the most. You flipped it today, people were buying up some of these laggards, right? And overall, when you think about market breadth and a lot of stocks participating in this instead of just those 7 stocks, for the long run, strategists typically argue that's a net positive.
All right. Thank you, Joshua. Appreciate it. Stick around. Much more Ask for a Trend. That's still to come. Well, ESPN's new streaming application that features everything the sports media arm of Disney has to offer will cost $29.99 per month. So as cable unravels, ESPN is betting big on streaming. And join me now for more is Joe Pompliano, host of the Yahoo Finance Sports Report. Joe, always good to see you. Let's talk ESPN, Joe, because on your Substack, you make what some might consider a contrarian take here. You say, despite ESPN losing nearly 30 million paying customers over the past 15 years, and everyone saying that the company is a dying business, unable to compete with deep-seated streamers like Amazon and Netflix, I believe you say ESPN is well-positioned to thrive in a streaming world. How come, Joe? Make the case.
Yeah, so there's a lot going on here, and thanks for having me, Josh. I think the argument with ESPN has always been that their cable business has really deteriorated over the last number of years. I mean, like you said, they had 100 million subscribers on cable about 15 years ago, and now they're down to 70. But this company's still making a lot of money. I mean, their operating income fell 17% last quarter, but it was still $700 million. They're making billions of dollars a year off the cable business. Now, what's difficult here is they have to kind of thread the needle by transitioning people to streaming without cannibalizing that cable business, which I just said still makes them a lot of money. But I think they're uniquely positioned to do that because they've spent the last few years gearing up for this. And the way they've been gearing up for it is sort of twofold. On one side, they've been overpaying for premium sports rights. So if you go on ESPN, I mean, you're going to see everything from NFL games to NBA games. They have Wimbledon, the PGA Tour, they have NHL, they still have a little bit of MLB, but that's going away. They have UFC, they literally have everything. So if you're willing to sacrifice, call it 20 to 25% of the content, you can get a price on the streaming service that is a third of the price of what you would pay for YouTube TV or something else like that. Then on the other side of the equation, they're also building up this content arm that I think is going to be really valuable too. They had this groundbreaking kind of industry-shaking deal that was $85 million with Pat McAfee to license his show. They just did another one with Rich Eisen, and all indications are that they're going to continue spending in that area as well. So now you go to this platform and you're going to have the live games, which aren't currently on ESPN Plus, but you're also going to have content. You're going to be able to check your fantasy stats. You're going to be able to bet on sports integrated in the podcast. You're going to be able to buy merchandise and do other things like that as well. It's going to be fully customizable. So I think it's going to be a really unique offering that, again, they don't need 50 million people to sign up for this thing. They just need a few million people for it to make sense as they start to transition people from cable to streaming. And it's going to be tough because you don't want to cannibalize the cable business. But at the end of the day, I think they're positioned well with their offering to do that.
You mentioned Rich Eisen. Just interested, Joe. What'd you make of Eisen's return to ESPN?
I thought it was great. I mean, he's got a really unique deal where his show is only going to be on the streaming component, so it's probably a little bit more valuable for ESPN. But again, ESPN is showing a willingness to do some of these licensing deals where Eisen and McAfee, they still run their entire operation. They pay their employees, they take care of the production costs, they have total editorial control, which is very unique and sort of different from what they've done in the past. If you look at all their other shows, First Take, Get Up, NFL Live, these are ESPN branded shows that they control, they manage, they own. Whereas now they're doing some of these licensing deals, which I would call sort of like YouTube style content. And it just shows how much the narrative and the content business has changed over the years. Whereas 10 years ago, not only did these shows not exist, but ESPN never would have done one of these deals.
Joe, switching gears, I need your take on another headline in your world today. Bloomberg reporting the San Francisco 49ers reaching a deal to sell stakes in the team at a valuation of about $8.5 billion. It breaks the record for a sports franchise set in December. What did you make of that headline and report, Joe?
Yeah, it's not surprising. I think this is something that we've seen over the past couple of months, but we're going to see a lot more of in the future as well. And it's sort of twofold also, because if you think about why this is happening, NFL valuations have gone up tremendously over the last couple of decades. The 49ers specifically, the ownership group there took control of that team about 25 years ago, and that valuation is now at $8.5 billion. So they're probably looking to take a little bit of money off the table by selling just 6%. Jed York is still going to control over 90% of the team. So again, he's not really giving up anything other than just getting some cash in return because the valuation has gone up so much because of the media rights deals. But that's sort of one bucket. The other bucket is the private equity side of things. The NFL recently relaxed some of its rules to get more in line with what the NBA and other leagues like that have done, where these private equity teams can come in and buy 5-10% of a team. And again, it's another way for these owners to get some liquidity and get some cash out of the business. And it's great for the private equity funds because they're able to charge management fees on this money, and it's long-term capital that's going to be locked up for a while, and it's also going to produce returns that I think have averaged annualized about 15% over the last 10 years. So pretty strong performance there too.
Joe, always great to see you and to have you on the show, my friend. And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report that drops every Thursday at 5 p.m. Eastern. Well, the average estimated monthly mortgage payment has more than doubled in just over 5 years. And Yahoo Finance's Julie Hyman joins me now with a closer look in our chart of the day. Julie.
home buyers have patiently been waiting for relief on the mortgage rate front, and it hasn't really arrived. And this is feeling its way throughout the system in a number of different ways. But let's get to the chart first of all, because this comes to us courtesy of Strategas. They're looking at a 30-year fixed rate mortgage. They're looking at the median home price. You add them up, and what you get as of April was a monthly payment of over $2,600, which indeed is a more than doubling from where it was at the end of 2019. And this sort of explains why we have seen some of the dismal numbers coming out of the home building industry. Just today, the National Home Builders coming out with their confidence index. It was the lowest since late 2023. Tomorrow, we're going to get housing starts numbers. We're going to get building permits numbers. And this is also why one of the many reasons why there's so much focus on the Federal Reserve and what they're doing with rates, because rates tend to be indexed to what we see for mortgage rates. Now, Ryan Grabinski over at Strategas writing, housing has an affordability problem. And this chart makes it very obvious why that is a problem. He also points out that when you look at lower income consumers, when you start to go up the income spectrum, the balance of people's net worth tilts more towards other types of assets besides real estate, namely stocks. On the lower end of the income spectrum, a lot of people's net worth tends to be tied up in their home. So if there is a freeze on new home buying, for example, if there are not new people entering the market, for example, that can be a problem throughout the economy. It's also, by the way, all of this is a problem for home building stocks. I was taking a look at some of the returns here. You got the year to date, just equal weighting it so you can see the red here that we are seeing across the board for many of the home builders, which have been experiencing a lot of pain here. A lot of them have been offering incentives to get people into homes. Josh?
All right, thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.